Let's talk about the euro. In this video, I want to discuss the advantages and disadvantages of this currency. Let's start with the advantages. The first advantage of a single currency is that it increases trade between the countries that use it. To better understand how this works, consider the following simple example. Before the euro, each country had its own currency. When a French company wanted to sell its products to other European countries, it faced the following problem. Germans could only buy these products using German Deutsche Marks, Italians using Lira, the Dutch using Guilders, and so on. Therefore, every European exporter was forced to deal with a large number of different European currencies, which in turn created additional administrative and transaction costs associated with accounting and exchanging these currencies. Moreover, when a company keeps its financial records in different currencies whose exchange rates are constantly changing relative to one another, it faces additional financial risks. Imagine that a French company has set a fixed price for its products on the German market, while the exchange rate is constantly fluctuating. This means that each time the company converts its revenue, it receives a different amount in French francs for the same amount of Deutsche Marks. Of course, when revenues are relatively small, such fluctuations are not critical. However, when a company's revenue is measured in billions, an exchange rate change of just a few percent can result in additional gains or losses from exchange rate movements amounting to tens of millions. Believe me, this is a rather serious problem even in the modern world. Of course, Europeans tried to address it. Even before the introduction of a single currency, they developed a mechanism with the interesting name the snake in the tunnel, under which exchange rates were kept within a narrow band. It was later replaced by the European exchange rate mechanism, which was based on similar principles. However, none of these mechanisms was perfect. Gradually, policymakers came to the conclusion that Europe needed a single currency. In theory, European countries could have adopted the US dollar. However, the leading European countries did not want to become dependent on the United States. At the same time, some countries did not want to accept another country's currency as the monetary standard, as had effectively been the case with the Deutsche Mark. Therefore, a compromise was reached to create a single currency that would be controlled not by any individual country, but by an independent supranational institution. The second advantage of such a currency is price stability. Part of this stability stems from the elimination of currency risk. With a single currency, companies can better predict their cash flows because they are no longer exposed to exchange rate fluctuations. This, in turn, affects companies' pricing policies and contributes to greater price stability. The second factor contributing to this stability is fiscal discipline, since none of the member countries can independently control the issuance of the euro. The third advantage of a single currency is its ability to increase the collective influence of its member states. Relatively speaking, it is difficult for an individual European country to persuade trading partners from other parts of the world to use its national currency for international trade. At best, those partners may agree to use a widely recognized reserve currency, such as the US dollar or the British pound. However, the situation is completely different when several influential countries share the same currency. Together, they have much greater bargaining power and can more easily convince their trading partners to use the euro as the currency for international transactions. In fact, it is precisely because of this collective influence that the euro has become the second most important currency in the world. This status also helps reduce the currency risks associated with using other currencies. That concludes our brief overview of the advantages. Now let's move on to the disadvantages. One of the main disadvantages of the euro is the loss of monetary independence. You might ask whether this is really a problem if governments are prevented from recklessly printing money. Personally, I would say that a national currency is simply a tool, and its effectiveness depends on who is using it. If a country is governed by a weak, corrupt, or incompetent government, then it may indeed be better if that government cannot control the money supply. However, if a competent government genuinely committed to the country's economic development comes to power, the lack of control over monetary policy can significantly limit its ability to respond to economic challenges. Moreover, every country periodically experiences economic crises and downturns. To deal with these situations, governments often need the flexibility to implement Keynesian-style deficit spending and expansionary monetary policies. Without control over their own currency, these policy options become much more limited. The second drawback is the different economic conditions across the member countries. What do I mean by that? The countries of the Eurozone are in different economic conditions and at different stages of economic development. Countries such as Germany and France joined the Eurozone as highly developed economies and benefited greatly from adopting the common currency. Other countries, such as Greece, had not yet reached the same level of economic development, and therefore were not able to enjoy all the benefits of a single currency. In addition, Eurozone countries differ in terms of economic growth, unemployment, and inflation. Countries with higher inflation generally require higher interest rates, while countries with high unemployment often need lower interest rates to stimulate economic activity. However, because the Eurozone has a single currency and a common monetary policy, the European Central Bank sets one interest rate for all member states. As a result, a policy that is appropriate for one country may be harmful to another, as has been the case for countries such as Italy and Greece. The third drawback is what I would call the paradox of a single currency. What does this mean? The United States regularly monitors other countries for alleged currency manipulation. When a country is placed on this watch list, it generally means that its currency is considered undervalued. In Germany's case, this effectively means that the euro is viewed as being undervalued against the US dollar. However, the Eurozone consists not only of Germany, but also of many other countries, and not all of them run trade surpluses. For example, Greece has often experienced a trade deficit. This creates a paradox. For Germany, the euro is often considered undervalued, giving German exporters a competitive advantage. For Greece, however, the same exchange rate may actually be too strong, making Greek exports less competitive.